Hello everyone. What an eventful week it was that started with the US inflation print, followed by FOMC and monetary policy meets by BOE and the European Central Bank. As expected, US CPI moderated for the fifth straight month, registering a lower number since December 2021. Lower inflation print cheered the financial markets as everything from equities to commodities rose sharply. Then came the central bankers meeting that disappointed investors as they sounded hawkish as against the market expectation. After the monetary policy, losses were witnessed across financial markets as profit taking set in. Let's understand what's in store in the fresh week through this weekly commodity podcast with me, your host and guide Ravindra Rao from Kotak Securities Commodities Research Desk. As always, I'll guide you through the fundamentals and technical triggers for commodities that will help you in taking an informed trading decision. It was a volatile week as commodities moved between gains and losses driven by major fundamental events. Week started on a steady note as traders awaited the US CPI print followed by the central bankers' policy meetings. However, after the US CPI print, markets cheered the moderation of inflation for the fifth straight week. US CPI came in at 7.1% in November as compared to a reading of 7.7% in October. It was the lowest number since December 2021. The economists had forecasted for a reading of 7.3%. Risk on was witnessed after the inflation data as equities and commodities witnessed a sharp rally. US dollar was dumped as the DXY registered a low of 103.44. Then came the conclusion of the last FOMC meet on Wednesday. Moderation in inflation flared up the expectation of a dovish Fed with 50 basis point hike. Although the interest rate hike was as per the consensus, the Fed chair sounded a bit hawkish that disappointed investors. Dollar index was quick to recover as it was trading near the 252-day moving average support near 103.50. Losses were witnessed across financial markets as profit-taking paired the gains that were seen after the inflation reports. Fed signaled that the terminal rate will be higher than initially expected. The softening of inflation indicated that the Fed's aggressive stance on increasing the interest rate is having an impact as the inflation is down from a 40-year high. However, it is still well above the central bank's target rate of 2%. This was the main driver for Fed's higher than expected interest rates in the future. Focus for the week will now shift to the US housing data, consumer confidence, followed by Q3 GDP due to be released this week. Weakness in the data might once again trigger selling in US dollars, supporting commodities. On the price front, as expected, the US dollar index took support near the 252-day moving average of 103.56. Now, the bears will have to pull it lower below 103.44, which is the previous week's low, to pull it further lower. If the bears fail, a bounce towards 105.75 can't be ruled out. Coming to commodity specific, both the precious metals, that is gold and silver, registered a new 5 and 7-month high respectively as moderation in inflation print pressured US dollar and 10-year bond yields, supporting the non-yielding bullion. However, the optimism faded quickly as hawkish sounding Fed gave dollar a push from lower levels that triggered profit taking in precious metals. COMEX gold ended the week lower by 0.58%, whereas silver lost around 1.64% to end the week near $23.30 per ounce. Investors will now keep a watch on the upcoming US economic data prints to take a cue on the Fed's future stance as moderation of inflation has at least pushed Fed to slow down on the pace of rate hike. However, it will be crucial to see when the Fed will pause as the aggressive stance has taken a toll on economic growth with fears of looming recession. Having said that, focus will now turn to the US GDP, US data prints like housing data, consumer confidence, and all important Q3 GDP. Weak data prints might support precious metals as dollar might weaken further and vice versa. On the price front, COMEX gold is still holding the double top resistance near $18.25 per ounce. A sustained break above $18.25 on closing might push the price higher towards the next resistance near $18.84. Support is near $17.78, below which we can conclude a temporary top near $18.25. On the MCX, support is pegged near 53,670, a possible demand zone. Reversal support near 53,460. Sustained close below 53,460 would indicate a short-term top, as the price might enter a year-end consolidation phase. In case of silver, in our last podcast, we expected price to test 24.20 as it was sustainably trading above the support of 22.50 per ounce. This happened as March futures tested a high of 24.39 per ounce. Support for the week would be near 22.74, which is the last week's low. Break of 22.74 on closing might pull the price lower towards the 252 DMA support near 22 per ounce. If the bulls hold the support, we expect price to consolidate between 24.20 to 23 for the week. On the MCX, support would be near 66,750, which is near the last week's low. Below that, the bears might target 66,000 followed by 65,500. If the support holds, we expect a consolidation between 67,000 to 68,800 for the week. Coming to energy, WTI crude recovered from its year's low of $70.08 per barrel. We mentioned last week that any bullish trigger might support the recovery in oil, and it might test $76 very quickly. This happened as price recovered on supply tightness coupled with the US dollar fall and reached a high of $77.70 in the first 3 days of the week. In the early part of the previous week, crude was supported by a shutdown of Canadian giant Keystone pipeline due to an oil spill of about 14,000 barrels into Kansas Creek. Additionally, oil got a boost as US reported cooler inflation in November that pressurized the greenback and sent commodities denominated in dollar higher. Crude rose from $70.08 to $77.70 in the first 3 days of the week. In the later part, crude gains were capped by partial reopening of the Canadian Keystone pipeline, easing the supply tightness along with the US dollar's recovery as central banks sounded hawkish. Build in oil and product inventories also supported the bear case. However, WTI crude managed to end this week with a gain of around 4.5% near $75 per barrel. Crude will continue to take cues from the US dollar as well as the inventory numbers. Any fall towards $70 per barrel will be supported as White House has already indicated that it will replenish its strategic petroleum reserves that has dropped to 40 years lows, close to $72 to $68. On the technical front, WTI crude has supports near $73 followed by 70.08 for the week. A close below $73 would turn it more weak as it might again move towards the low of $70.08. However, if $73 is held, there can be a consolidation between $73 and $77.70. A break and close above $77.70 would push the price further higher towards $81.50. On the MCX, the price range for the week would be between 5840 and 6400. On the metals front, all non-ferrous metals witnessed profit taking amid recessionary fears as central bankers maintained the hawkish tone. Latest indicators from China signaled towards worsening economic activity and raised fears of lower than expected growth in the fourth quarter, while disappointing economic data from the US highlighted signs of slowdown. China's retail sales contraction widened to 5.9% in November, while industrial output growth slowed to 2.2% from 5% in October. And fixed asset investment growth weakened to 5.3% in the first 11 months of the year. Disruptions at some mines in Peru could not provide any cushion against the macroeconomic stress. LME Zinc was the worst performer as it ended the week lower by 6.87%, followed by aluminium and copper that shed 4.25% and 3.24% respectively. On the price front, M6 copper might get support near the recent swing low of 694. A break of 694 on closing might pull the price further lower towards 688, 686. On the flip side, resistance is pegged near 710. A close above 710 would push the price towards 252-day moving average resistance near 720. In case of zinc, price is approaching the 52-day moving average support near 270. It coincides with the rising trend line support near 268. So until the set support zone of 270 and 268 holds, bounce can be expected towards 281. Break of 268 on daily closing might pull it lower towards 259. With this, we come to the end of this podcast. To conclude, a focus for the week would be on the US data prints like US housing data, consumer confidence, US final GDP, and Fed's preferred inflation gauge, core PCE, for more hints on economic situation, as they will officially be the last crucial important indicators release of 2022 before the start of Christmas and New Year holidays. Better than expected print might further boost dollar's recovery, and commodities might continue to fall. Besides, hawkish Fed will keep investors wary and limit global risk appetite ahead of holidays. All the best. Trade safe.